all of us would have heard about the advice of be fearful while others are greedy, and also be greedy while others are fearful. But I think it's really easier said than done, because most of the time, especially when it comes to reality, when we need to perform a lot of investment decision, it actually involves a lot of emotional factors that were surrounding our investment decisions. So I think it's really easier said than done, to be greedy while others are fearful, especially if you look at this kind of current situations. On a daily basis, you can see S&P 500, it can move up 2-3% on a daily basis, and down another 2-3% on the next subsequent days. So exactly at this kind of a volatile market environment, how should we position our portfolio? I think this is something that we want to share with all of you in the next 30 to 45 minutes. We are going to share with you what are the changes that we have made for our portfolio over the past couple of weeks and also past couple of months, especially during the market downturn. What are some of the changes that we have made to the portfolio to position the portfolio in a more greedy approach to capture the upcoming rebound in the global equity markets? So if we take a look, if we move on to the next slide, here you can see this is the agenda for today's sessions. So we are going to share a little bit on, we are going to do some of the market recaps on the global equity markets, what have already happened in the past couple of weeks and also past couple of months. And on top of it, we also want to share with you a little bit on the market outlooks. How do we think about the markets on the next few quarters? The second part of my presentation is actually to share with you on the performance of our portfolio, how the portfolio performs against the benchmark. And the last one is to share with you on the strategy. So these are some of the strategy that we have taken for the portfolio, and we would like to take this opportunity to share with every one of you on the portfolio strategy. Oh no, I see there's some line over here. Yep, okay, it is. Yeah, it's becoming better now. All right, okay, so without further ado, just let me start the session today. All right, okay, so if we look at the performance of the global equity markets, on the left-hand side here, we have the charts for the global equity performance and also for Malaysia equity performance. So if we take a look on the global equity first, now the blue color line, what we can see here is that in the early of 2020, global equity actually performed relatively strong. If you look at it in the first 1.5 months, global equity actually hit the all-time high level. Part of the reason is because of the resolution to the US-China trade tension. In the beginning of January, China and US, they able to sign the first phase of a trade deal that actually gives a hope to the global investor and to the global economy that the global economy is likely to recover for the year of 2020, given the trade resolution between US and China. And subsequently, right after China reported the first cases of COVID-19 and also followed by the outbreak, the virus outbreak in China, the global equity market, especially on the developed market part, the US and also European equity, they remain rather resilient. In fact, they actually trended upward after the outbreak in China. The reason why is because during this period, towards the end of January and also the beginning of February, this is a period where US and also European companies, they reported their fourth quarterly earnings. So the earnings turned out to be better than expected, and these are the reasons that have drove the equity market higher. But subsequently, what happened is, when the earnings season came to the end, the global investors started to shift back their focus to the current issue, which is the COVID-19 outbreak. And coincidentally, during the end of February, that's when the outbreak started to happen outside China, in Iran, in France, in Spain, and I think in early March, that's when the outbreak started in US. So these are some of the factors that have triggered a massive sell-off in the global equity markets. On top of it, in early March, the decline in the oil prices that dropped more than 30% on a single day basis, that has accelerated to sell off in some of these emerging markets where they are relying on the oil productions. And if you take a step back and look at Malaysia equity, on top of the decline in the oil prices, on top of the virus outbreak, if you all still can recall, early this year in February, there is a political uncertainty in Malaysia. There's a change in government, and that one actually caused the foreign investor to pull out their money aggressively from Malaysia asset, be it the equity and also the fixed income asset. So they have been pulling out their asset aggressively. So from foreign investor point of view, the change in government actually have shaken their confidence. I mean, over the past 2 to 3 years, especially during the previous change to the previous election, where there's a change in government, it has already shaken the foreign investor confidence. From the foreign investor point of view, they prefer, the same government for a country throughout a long period of time, because that will ensure political stability and also policy continuity. So that's something that foreign investor is looking at. But if you look at it over the past 3 to 4 years, we have 2 times of changes, in terms of on the political scene. So that one, we think that over the next short to mid-term perspective, it is very unlikely for foreign investor to return back to Malaysia equity or Malaysia fixed income asset, because to a certain extent they will have lost much of their confidence on Malaysia asset due to the political uncertainties. And if you take a look on the table on your right hand side here, you can see the returns for the various markets that under our coverage. So in summary, there's no markets that deliver positive returns on a year-to-date basis. But we can see China market, Taiwan, and also Hong Kong markets, they are the markets that remain rather resilient. But on a year-to-date basis, as of 30th April, all of these markets, they are in negative territory, mainly due to the COVID-19 outbreak. If we move on to the next slide, take a look on the COVID-19 front. What we can observe here is that on the positive side, we can observe that the daily growth rate has started to trend lower and stabilize at around 3% level. From the beginning of 25 to 30% kind of a daily growth rate, right now we are stabilizing at around 3%. So this is something that's encouraging, but it's not something that we really want to cheer about, because try to think about it on a mathematical point of view. Previously, where we are having about 30 to 40,000 kind of daily confirmed cases, growing at 20 to 30%, it means that we would have another 6 to 7,000 cases on a daily basis. But right now we have a base of 3 million, more than 3 million. In fact, it's 3.5, 3.6 million. Going at just 3%, it means on a daily basis, we have more than 90,000 of cases globally. So it actually means that the base effect is actually one of the factors that causes the daily growth rate to trend over. But something to look at is that because right now COVID-19 is known as pandemic, and the virus is very contagious, and given this kind of a contagious virus, the thing is, if you look at it from a pandemic perspective, if we assume that every one's patient is going to spread out the virus to another 5 patients, without considering the base, no matter the base is 3,000, 30,000, or 3 million, given this virus being so contagious, we will be able to grow at a similar rates regardless of what is the base. But the good thing is that globally, we see a lot of governments have been putting a lot of efforts, to stop the virus from spreading rapidly. We see a lot of social distancing measures being implemented, a lot of lockdown being implemented globally. So to a certain extent, this kind of social distancing measures has been very effective to stop or to slow down the daily growth rate of COVID-19. So what we are hoping to see from the current level is that we hope to see the daily confirmed cases to stabilize and to start to trend lower. If this is the case, over the next couple of weeks, if we started to see the daily confirmed cases to slow down and to trend over, I think this could be one of the very positive factors to the global equity and also to the global economy. Moving on to the next slide, let's assess the impact of the COVID-19 to the global economy. If you look at it, I think a lot of investors, they are actually asking whether or not are we heading to a global recession over the next few months or next few quarters. I think if you take a look on some of these leading indicators, we can safely assume that right now we are actually in the middle of a recession. If you take a look on some of these leading indicators, like for example, the PMI data, the Purchasing Manager Index, it is a survey that going to ask around some of these business owners, some of these manufacturers, their opinions about the outlooks for the global economy and also the outlooks for the business. Are they expanding their business? Are they hiring? Are they buying inventory? So if you look at this index itself, it has plunged one of the lowest level in history, which indicates that very likely for the first and second quarter, we are going to see a significant contraction in the global economy. And the second one on your right hand side here, the BCOM index, which is the Bloomberg Commodity Index. If you take a look on this index, what we can see is that commodity prices is strongly correlated with the global economic outlook. During good time where the economic growing strongly, for example in 2017, where we have a year of a global synchronized growth. In 2017, the commodity prices actually trended upward because in a year with a strong global growth, it will actually increase the demand for commodity and it will actually translate into the higher price for commodity. So this is the how to explain it between the commodity prices and also the strong economic growth outlook. So if you look at it in the past 2 years, in 2018 and 2019, commodity prices have trended lower and went sideways in 2019. It is purely because of the trade issue between US and China, which actually saw the global economic growth generally over the past 2 years. And recently, we see the commodity prices have plunged significantly. It also indicates that there will be slowing demand for commodity. And this is if this is correlated, if history is any guide, this is correlated with the global economic growth, we can safely assume that right now we are going to see a significant contraction in global economy, and global recession is really something that's inevitable at the current juncture. But something to take note is that I believe a lot of investors, when we talk about global recession, they are very worried. Some of them, they are thinking to sell most of their exposure because recession is coming. I mentioned just now, we are in the middle of recessions. Something that we need to take note is that stock markets always move way ahead of macroeconomic data. If you look at the historical data, historically it has shown us that no matter in the year of 2003 during the SARS period, or during the subprime crisis period, or in the period in 2015 and 2016, where we see the oil prices plunge significantly from $100 per barrel to all the way to $20+ per barrel, as well as during that period, we actually experienced the crisis in the Chinese equity market. So no matter in which periods, most of the time or majority of the time, the equity markets tend to bottom and rebounded way before we have the data to confirm that there is a recession or to confirm that the economic outlook in the previous quarter was pretty bad. So what we can assume here is that if you look at equity market, it always moves way ahead of macro data. Equity market is forward looking. They don't price, you won't see in certain period where GDP came out to be worse than expected, then the equity market plunged significantly. Most of the time in this kind of situation where generally analysts or generally economists, they have predicted that the economy is going to be very, very bad, equity market tend to price most of these negative data. They will have priced in most of the negative data. So this is something that we want to consider. Even though we are expecting over the next few quarters, over the next few months, that the macro data, the headline data is going to be very weak, but we might want to consider to assess to see whether or not have these bad data, have these poor data been reflected in the equity prices. The other thing to share with all of you is that the historic stimulus that have been put up by the global central bank and also put up by the global governments. If you think about it, a lot of investors have been asking us what have caused the recent rebound in the global equity market, particularly in the US equity market. It has rebounded more than 25% from the bottom level in middle of March. The reason why is because of the stimulus that have been put in by the US Central Bank, the US Federal Reserve, as well as by the US government. If you look at it, right after the virus outbreak in US, Fed have moved very swiftly to cut the interest rate to the range of 0 to 0.25%. At the same time, Fed have also injected plenty of liquidity. They have injected trillions and trillions of dollars into the financial system, into the banking system, to ensure that there's sufficient liquidity in the markets. And on the fiscal side as well, if you look at some of the fiscal stimulus that have been put up by the US government, that have been signed by Donald Trump, they also have put up trillion and trillion of dollars into the economy to help the SME, to help some of the unemployed people and also some of the people that have been affected by this COVID-19. I think to really explain on this, I would like to borrow a quote from one of the industry experts that he have mentioned recently. He mentioned, and I quote, that money have to find a home, which means that whether you like it or not, with the current excess liquidity in the financial system, especially after Fed have restarted the quantitative easing, the QE. I mean, this amount of money has to go somewhere, and it does explain the recent surge in the commodity prices. And this is also related to one of the famous quotes people used to say, which is "Don't fight the Fed," which means when Fed is pumping liquidity into the financial system, Fed is injecting money into the banking system, is cutting interest rate, to a certain extent, we shouldn't be overly bearish on the equity market outlook. Where we know now, right now, if you look at it globally, global economy is going to face a severe contraction. But if you look at the unprecedented stimulus that have been put in by the global central bank and the global government, it's not only in US. If you look at it globally, in China, in UK, in European countries, in most of the Asian countries, all the government have been putting a lot of effort to help to revive and to stabilize the local economic growth. And this exactly, to a certain extent, we shouldn't be overly bearish or overly pessimistic on the economic outlook. Yeah, so to summarize on what has happened and also what our outlook, basically we think that the first thing is we think that global recession is something that we couldn't avoid. Right now we are in the middle of global recessions, but we need to take note that equity markets always move way ahead of the macro data. The equity market will have priced in much of this negative data. So third thing we need to take note is that if you look at the current stimulus that being put up by the central bank and also by the government, I think it would help to cushion much of the downside risk. Once things stabilize, once the COVID-19 cases stabilize, we are likely to see a very, very strong rebound in the global economy as compared to the previous crisis. Because if you look at it this time around, central bank and the government, they act very swiftly to come up with all these stimulus plans as compared to the previous crisis. Yeah, so these are the things that somehow, I think right now, just to share with you all, we are still bullish on the equity markets, and on our portfolio position, we are actually on a 5% overweight in equity markets. So moving on to the next slide, I'm going to share with you on the portfolio performance for our FSMOne managed portfolio. So if you look at the portfolio performance, we have our conventional portfolio on the top and also the Islamic portfolio on the bottom. So what we can see is that over the past 1 month in April, our portfolio rebounded from 3.6% to 8.7% for the 5 respective portfolio, from conservative all the way to aggressive for the conventional portfolio. And on top of it, if you look at it, in fact, if you look at it from the bottom level since late March, the portfolio in fact have rebounded close to 20% for the aggressive portfolio from the bottom level in somewhere in 23rd or 24th of March. So the portfolio rebounded very strongly over the past 1.5 months. And if you look at the performance across different tenure, our portfolio actually outperformed most of the global benchmark, across different tenure. And the portfolio performance is actually indicated under DPMS. And this is a global benchmark performance. So some of you might be interested to know how do we construct the global benchmark for our portfolio, and is it reflective of what we are doing for the portfolio? So if you look at the benchmark itself, how we come up with the benchmark, for example, if we take an aggressive portfolio as an example, for the aggressive portfolio, because we have 90% in equity and 10% in fixed income. So how we come up with the benchmark is that we take 90% of the performance from MSCI, ACWI, GDP weighted index. I think you can see it over here, MSCI ACWI GDP weighted index, and 10% of the fixed income exposure from Bloomberg Global Aggregate Bond Index, or in MYR term. So this is how we come up with the benchmark. The reason why we take MSCI GDP weighted index is because this is the benchmark that we use to construct the portfolio allocation. So we think that it's more representative. It's more reflective of our current portfolio allocation. So we compare it against the benchmark, and if you look at it across different tenure, the portfolio actually managed to outperform the benchmark across different tenure. And for Islamic portfolio over the past 1 month, the portfolio up about 3.9 to 8.6%. And in fact, most of our Islamic portfolio also managed to outperform the benchmark. So the benchmark for the Islamic portfolio equity part, we are using MSCI ACWI Islamic Index, and also for the fixed income side, we're actually using Maybank Islamic 5-year FD rate. The reason why we are not using any bond benchmark is because globally we don't have any Islamic fixed income, or Islamic Sukuk benchmark. So we are using a 5-year FD rates to replace the returns for the fixed income exposure. So if we move on from the performance figure, this is also something that we want to share with all of you, the resiliency of the portfolio. Here I put up the maximum drawdown. What it means by maximum drawdown is that from a certain period, this is a maximum drawdown for the year of 2020. It means over the past couple of months, how much that this portfolio of this market has dropped from their bottom to the peak, from the peak level to the bottom level. How much is a drawdown in the respective market and in the respective portfolio from January until end of April. So what we can see here is that most of our portfolio, because we do practice a proper diversifications for the portfolio, what you can see here is that across the 3 portfolio, conservative, balanced, and aggressive, we only put up 3 because if you look at it, moderate, conservative, and moderate, aggressive, it will be in between of for moderate conservative, it will be in between of our conservative and balanced. For moderate aggressive, it will be in between of our balanced and also aggressive portfolio. So we only put up 3 to make sure that it's not that confusing. So if you look at all our portfolio, it tends to be more resilient as compared to the global equity market. The drawdown is less significant compared to the global equity market. For example, if you look at our aggressive portfolio, which has 90% of the allocation into the global equity market, it only dropped about 24% during the recent sell-off. If you look at global equity market actually dropped close to 30%, around 29% during the recent sell-off. So this is also something that what we have been emphasizing over the past few years, or this is what we have been emphasizing. We always encourage investors to invest in a portfolio approach and also to practice proper diversifications, because we know that if you look at market investment, if you look at the equity market itself, is unpredictable. We wouldn't be able to predict how the equity market is going to move over the next couple of months or next couple of quarters. With proper diversifications and with a systematic asset allocation strategy, it not only helps you to cushion the downside risk, the maximum drawdown of the portfolio. At the same time, when one market's rebounded strongly, if your portfolio practice proper diversification, you will be also able to capture the strong rebound in the respective markets without missing out the rebound in that particular markets. So this is the reason why we always emphasize our investor to do practice diversification for your portfolio. Don't over concentrate your portfolio exposure in a certain markets. Yeah, so in this side, we can see some of the changes that we have made to the portfolio. So I'm just going to go through on Islamic portfolio first. For Islamic portfolio, we have rebalanced the portfolio in early March after the first wave of sell-off. So we look at it, the rebalancing, it doesn't happen exactly at the bottom of the market, but the subsequent rebound in the global equity market, it actually benefited our investor, because after the rebalancing, we have actually increased our allocation into the equity portfolio and reduced our allocation in the fixed income portfolio. So right after the rebalancing, when the market rebounded subsequently, it actually benefited our investor with a higher allocation into the equity markets. And for our Islamic portfolio, in the month of April, early April, we have actually replaced the BIMB Global Dividend Fund with Principal Direct Equity Funds. So the reason why we took out BIMB funds from our portfolio is because back in late March, we realized that BIMB fund, they actually hold about 70 to 75% of their cash, their allocation in cash, means that they are not investing in the markets because of the volatility in the markets, because of all this uncertainty. The fund have raised their cash level to 70 to 75%. And we believe, with 70 to 75% of our cash allocation, if subsequently equity market rebounded, this fund is going to miss out on the strong rebound in the global equity market. That's why we replaced it with Principal Direct Equity. Back then, I think Principal Direct Equity, they only hold less than 5% of their exposure in cash. And in the rebound, for the rebound in April, the BIMB Global Dividend, they've rebounded just about 3 to 4% from the bottom level. And for direct equity, they have actually rebounded more than 12-13% from the bottom level. So that's actually explained why we actually took out BIMB and replaced it with Principal Direct Equity. And in just a few days ago, we also made a changes to our Islamic portfolio, which is on the fixed income side. We took out RHB Islamic Bond Fund and we replaced it with Maybank Malaysia Sukuk Fund. This is, I think, a very long story regarding these changes, but basically it's because of the previous downgrades in RHB Islamic Bond Fund. If you still can recall, over the past 2 years in 2018 and 2019, RHB Islamic Bond Fund, they experienced 3 downgrades in just within a short period of 2 years. The downgrades, after the downgrades, we have actually analyzed into the individual security, the papers that they are holdings that have been downgraded. We understand that in one of the paper that they hold that got downgraded recently, which is the Bright Focus bond, we understand that the reason that the rating agency downgraded the paper is because of the advance payment from the subsidiary to the mother company. And that's actually caused a deterioration in their FSCR, the finance service coverage ratio. So, but if you look at fundamentally the underlying highway, the max highway for Bright Focus, the traffic projection for this bond paper, for this highway, is actually better than expected, and it is one of the few in Malaysia that have a better than projected traffic. So we think that fundamentally the bond paper is still remain very strong, and we see a possibility of the rating agency to re-upgrade this bond paper. But what happened, why recently we shift this bond out from our portfolio, is because after the MCO, we understand that the traffic will have been affected for most of the highway. So this will cause revenue loss for most of these highway companies. And previously we have communicated with the rating agency, and we understand that for this paper, it is very close, the FSCR ratio, because previously why the rating agency downgraded this paper is because the FSCR ratio, the finance service debt coverage ratio, is very close to another level that will trigger a downgrade. So we think that if with the recent loss in revenue due to the imposition of MCO, that could trigger another downgrade for this bond. So this is something that we are worrying. And all this while, the reason why we put up bond fixed income exposure into the portfolio is to stabilize the overall portfolio for our investor. So we do not want to take unnecessary risk for the portfolio. So on the safety side, on the more conservative side, we rather to sacrifice on the upside for these funds, for RHB Islamic Bond Fund, and go to the safer one, Maybank Malaysia Sukuk. We rather to take the risk from the equity market at this moment, because if you look at currently, I think if we consider the upside potential, we think that the risk is rather worth for us to take from the equity markets as compared to the bond market. That's why we actually decided, make the decision to remove RHB Islamic bond fund from the portfolio. So those are some of the changes for our Islamic portfolio. For our conventional portfolio, same thing. We have rebalanced the portfolio in March. It's the same thing. It's not exactly the bottom level, but the subsequent rebound has also benefited our investor with a higher allocation into the equity markets. On top of it, at the same period of time in early March, we also reduced our overweight position in long duration bond to neutral position. So we have been overweighting our long duration bond for I think 1.5 to 2 years. If you look at it, over the past 2 years, long duration bond has been outperforming the short duration bond. Because central bank has been cutting interest rates since last year. So we think that the alpha that have been generated by the long duration bond fund is sufficient enough, and we see the yield for the long duration bond have compressed significantly after the 2 unexpected rate cut by our central bank early this year. So we have reduced our overweight position and make it to a neutral position for our Malaysia long duration bond fund. And in early April, we have added Global Technology Fund into our portfolio on 1st of April. And we also added a US high yield bond fund into our portfolio, which I'm going to explain to you why we added these 2 exposures into the portfolio. So if we move on to the portfolio strategy, just to share with you how we actually position our portfolio after the recent sell-off. Right now, in terms of inter-asset allocations, we are still overweighting equity by 5%. So we think if you look at the current situations, despite that the global outlook is look very bad, the headline data is going to be very weak. We are likely to see a poor data over the next couple of months. But if you think from a valuation perspective and you think from the stimulus perspective, we think that it's still worth for us to take on the 5% overweight in equity. So we go in details for each of the segments or each of the sector exposure. For fixed income, we are actually underweighting Malaysia short duration. We have a neutral allocation in Malaysia long duration, Asian bond, emerging market bond. And we have a tactical allocations. Right now we have a tactical or supplementary portion in US high yield. So just to cut everything short for Malaysia bond, we expect the interest rate to remain pretty low for the rest of this year. And generally, I think markets are expecting another rate cut by central bank towards the end of this year. I think that's possible given how dovish the stance the central bank have been delivering during this round of MPC meeting. So we think that interest rate for Malaysia is likely to stay very low. But the bond prices for Malaysia short duration bond fund, we think that the upside is rather limited due to the short duration in nature. For long duration bond funds, we think we are able to get a lot more yield by taking up additional duration risk. Overall, we think that Malaysian bond, the local fixed income exposure remain very important for diversification purpose. If you think about it, historically, or maybe we take a very good example in the nearest to us in 2018, the global sell-off in global equity and also in global fixed income, Malaysia bonds still remain very resilient. They are the only asset class that deliver positive returns in 2018. And if we take some of the example, for example, during the subprime crisis, Malaysia bond, Malaysia fixed income asset, Malaysia bond was also the only asset class that deliver positive returns. So we think that the low correlation for Malaysia bond against the global equity, against the global fixed income, make it a very important tool for diversification. That's why you look at our overall portfolio, we still have a very significant exposure in Malaysia bond, mainly for diversification purpose. For Asian and emerging market bond, after the recent sell-off, we think the valuation have went to a very attractive level, but there's still some risk within Asian and emerging market bond. For emerging market bond, especially if you look at it, the recent decline in commodity prices especially in the oil prices. We see some risk, credit risk. We see increasing credit risk in the emerging market space. But the easy liquidity environment and also the supportive fiscal policy, we think these together can help to cushion some of the downside risk. It will help this company to weather through this time of challenging periods. For US high yield, this is a segment that we have recently included in early April. The reason why we have included high yield in the portfolio, it was a tactical allocation in the portfolio, means that it is not in our core portfolio allocations. We are going to put it up it's a more tactical allocation for us. So the reason why we put up US high yield is because the recent sell-off in US high yield space, we think that this is more of a liquidity issue instead of a fundamental issue or credit issue. The reason why is because during the previous sell-off, the recent sell-off, there is this issue called liquidity crunch. It's forced investors to liquidate most of their risky asset, and US high yield segment is one of it. So if you look at it, the yield for US high yield segment, it has one spike all the way to close to 14%. At the time where we enter into the US high yield bond fund, the yield is trading about 13 to 14% yield to maturity, meaning that if you hold this high yield bond fund until maturity, you have gotten 13 to 14% kind of a returns from yield itself. So we think that it's very attractive, although we do expect the credit risk, the downgrade risk to increase substantially, or the default risk to increase substantially over the next couple of weeks and also next couple of months. But we think that with the 13 to 40% kind of yield that we have been rewarded by taking up the risk is worth enough for us to take the risk. So we have decided to take the position in US high yield, and the fund that we have chosen is FSMOne short duration high income fund. So I think the thing that worrying us on the US high yield is actually on the energy sector, the oil and gas sector, because with the declining oil prices, I think they will be the one. There will be the sectors that's going to see increasing default rate. But the fund that we have entered, the FSMOne short duration high income fund, they only have close to 3 to 5% of the energy sector, oil and gas sector. So that's really the exposure is not that high. So it is not that worrying for us in terms of the oil and gas exposure. And we move on to equity portfolio. Right now we are underweighting US, underweighting Europe, and we have a slightly overweight position in Japanese equity. So just to cut everything short, for US equity, way before the COVID-19 outbreak, we think that the economic data has started to show some weakness because the economy itself for US, they are in the late cycle. And also this time around with the COVID-19 outbreak, we think that the economy is likely to be badly hit. Reason is because the domestic consumption actually accounts for more than 60-70% of total US GDP. So with the weakening labor market in US, with the employment rates going to surge significantly, we think that that's going to hurt the consumption very much. And in terms of valuations, US equity is trading at a very expensive level. It's because of the recent earnings slash. Generally, I think global analysts has cut the earning forecast for US company S&P 500 as a whole. On average, they actually cut the earnings growth by more than 15%, 15%. So the cut in the earnings outlook, earnings growth is one of the factors that caused the valuation for US equity to be rather expensive compared to the regional peers. For Europe, we think that the recovery momentum is going to be weakened over the next couple of quarters, especially with the current virus outbreak, because services sector account for 75%. So with this kind of a lockdown being implemented in the European country, they will see a very bad GDP growth in the first and also second quarters. And on top of it, I think if you think from a monetary policy point of view, the interest rate in European country is close to zero. It means that there's limited tools, there's limited armor or bullets that the central bank can use to stimulate the economic growth. So we think that the depth and also the length of recession is likely to be more severe in European countries as compared to the Asian markets. For Japanese equity overall, we think that Japanese equity or Japanese economy, they are likely to be the first one in Asia to face so-called a technical recession. What do we mean by technical recessions? Basically, it means 2 consecutive quarters of GDP contraction. So in the last quarter of 2019, because of the hike in the sales tax, the consumption tax in Japan, that's already hurt the economy pretty much. We see in the last quarter of 2019, the Japanese GDP actually contracted, fell into the negative territory. So in the first quarter of this year, with the COVID-19 outbreak, it is very likely that Japan will be the first one in Asia to face a technical recession. But what we learn about Japanese equity is that generally the companies have a very, very strong balance sheet. Majority of the companies that listed in Japan, they have a very strong level of cash. This would help them to buffer through, to weather through this kind of a challenging period. And we have been talking to the fund manager that have been managing the funds that we have invested, the Sumitomo, the one that managed the UOB Japan Discovery Funds. So we have been talking to the fund manager, and we understand that the company that they have picked, fundamentally, they are very strong. In fact, they are still seeing year-on-year revenue and earnings growth. On top of it, they have a very strong balance sheet. That's why we are quite comfortable with the current situation, with the current fundamentals for the Japanese companies. And in terms of valuation-wise, Japanese equity within the developed markets peers, they are the one that's trading at a rather attractive level. And if we move on to the next part, we look at emerging markets, look at Asia, Japan equity, and China equity. Right now, we are overweighting Asia, Japan, and also China equity. Overall, as a whole, why we like Asia, Japan, and also China equity, we think that these are the markets that's going to recover much faster compared to the rest, given the room of the room that they have in terms of a monetary and also fiscal policy to stimulate the global the economic growth. And for China itself, you look at right now, China is actually in the late stage in combating the COVID-19 outbreak. And we think that right now the policymakers and also the government, they are more focused on how to revive, how to drive the economic growth instead of dealing with the virus in the rest of the country, in developed markets or in some of the Asian countries. And on top of it, we think that with the largest population in the world, this is likely to drive the long-term growth for China. And if you look at the transitions of China from an export-reliant country to a consumer-led economy, it actually benefited them a lot. And this is going to be one of the structural factors to drive the long-term growth for China economy. And like I mentioned just now, from a fiscal and from monetary policy point of view, China have ample room to tackle this kind of externalities and also the challenges. If you look at the current interest rate in China, it's about 3+%. Compared to the interest rate in developed markets, it's close to 0%. If you look at on the fiscal side, the debt to GDP for China is close to 50%, whereas in most of the developed market, they have over 100% of a debt to GDP level. And in terms of their fiscal deficit, right now, the China fiscal deficit to GDP is probably around 1%, 1 to 2% level, where in US and in Japan, their the fiscal deficit to GDP is about 4 to 5%. So from the policy point of view, we think that it's more attractive. And for China, they have much of this armor to really stimulate and to drive the growth for the Chinese economy moving into the next few quarters. And we believe that China will be the one that's going to lead the global recovery. For emerging market, it is very sensitive to commodity prices, and we think that the recovery from COVID-19, it might take a bit longer for emerging market as compared to the Asian economy, because in order to recover from this COVID-19, it's actually got to rely on their healthcare system, their infrastructure, and also their governance in each of the countries. So we think that EM, they might be at a more disadvantaged position as compared to much of the Asian economy. So although from the valuation level, they are still rather attractive, but from the recovery perspective, we think that it's more comfortable for us to keep a neutral position, and also because they are very sensitive to the commodity prices. And we look at the current level for most of the commodity prices, they are standing at close to the historical low level. So this will be something bad for the emerging market. But anyway, if you look at valuation perspective, they are still pretty attractive. So it meaning that much of this negative would have actually priced into the equity prices. Move on to this part for Malaysia, global tech and also global healthcare. Malaysia equity right now we keep a neutral stance. If you think about it, right now for Malaysia equity, we like the local small to mid cap sector. We think that the outlook for the big cap sector is rather gloomy because the low interest rate environment, the low commodity prices, and also the political uncertainty. These are some of the major headwinds for Malaysia large cap. Because if you think about Malaysia large cap, we look at KLCI, 40% of them they are banks, and then about 15% of them they are the plantation counters. So the low interest rate and the low commodity prices have a very significant impact to the big cap sector. On top of it, if you look at most of our big cap sector, I can say majority of them they have some, they are a little bit of political links company. So this is going to have a little bit of issue to some of these big cap company. We are ready to see some of the top management changes. There might be some reshuffling in the top management for some of these big cap companies, which have some political background. So these are some of the issues that we are looking at. We think that for big caps, the outlook is rather gloomy, but we are positive on the local small to mid cap sector. We like those sectors, for example, semiconductor, the technology sector. We think that the demands will continue to be there. Even with the current NCO, just to share with you all, some of the majority of the semiconductor sector, the semiconductor players, even with the previous stage of MCO, they are actually, majority of them, they are running at 50% of their capacity, meaning that they are not completely stopping their production. All of them, they're actually running at a minimum of 50% of their capacity, majority of the technology players. Yeah, so that will benefit them, that will help to reduce some of the downside risk to the tech players. And also, if you look at it, majority of the tech players, the semicon players in Malaysia, they earn their revenue and they earn their profit in US dollar. So the weakening of ringgit is likely to translate into higher revenue and profit for most of these tech players. The other sector that we also have a favorable view is the local construction players. We see limited risk for those infrastructure projects that has been resumed, that have been revived by the previous government. And if you think of it from the current situation perspective, for a government to really revive or to support the local economic growth, I think infrastructure projects is one of the sectors that they will prioritize, because infrastructure project or the infrastructure sector, they have the highest multiplier effects. Means that for every $1 trillion that you are spending, you are going to create few trillions more of a value to the overall economy. So the high multiplier effects will force the governments to really prioritize on the infrastructure sector to revive those infrastructure projects in order for them to support the local economic growth. And if you take a look for tech sector, for construction sector, even if you look at the biggest cap company within the two sector, the biggest player, none of them are in the big cap segment. The biggest player, if you look at it, for example, in tech is Inari. They are within the mid-cap segment. Or even for the construction sector, the biggest cap company, they are within the small to mid-cap segment. None of them are in the within the KLCI or within the biggest cap companies. So these are some of the reasons that somewhat why we actually have a favorable view on the local small to mid-cap sector. And for technology sector, this is one of the sectors that we have recently included into the portfolio. We have included 10% of the total equity allocation into the global tech sector. So we have officially included tech as the core allocation for our portfolio. So the inclusion is not into the supplementary, it's not into the tactical allocation for the portfolio, but into the core allocation of the portfolio. Why we include tech into the portfolio reason is because if you think about it, the digital economy is now contributing close to 10% of the global economy. And if you look at it, the tech sector, we think that tech technology counters could be one of the biggest beneficiary during this COVID-19 outbreak. Because if you look at, for example, if you look at the mega trend, such as 5G, such as AI, artificial intelligence, with or without the COVID-19 outbreak, we think that this is not something that's going to reverse in the future. Governments and also companies that has been spending a lot of money into this sector to really venture into this sector, explore into this sector, they are not going to reverse their spending. They are not going to reverse in this kind of trend, this mega trend, AI and 5G. And on top of it, if you look at the virus outbreak, way before this COVID-19 outbreak, we have been hearing about the online grocery shopping. We have been hearing about the online educations, online health services. But not everyone in the world that they have this chance or have to experience these online services. Because of the COVID-19 outbreak, everyone is forced to stay at home. And this gives them the opportunity to experience, for example, the online grocery shopping and also the food delivery services. So, and we think that when everyone's used to this kind of services, and this is not going to be something, this is not something that's going to be reversed in the future. And when people get used to it, it's going to increase the demand into this technology sector, the technology goods and services. So we think that the prospect for tech is very interesting, and if you look at in terms of earnings wise, just like I mentioned, S&P 500 as a whole, analysts have downgraded the earning by more than 15%. But technology sector, the global technology sector, their earnings only being revised downward by 5 to 6%. So we can see that the earnings for technology sector is rather resilient as compared to the rest of the sector in the world. And the last part, the last exposure that we have in the portfolio is on global healthcare. So we have included global healthcare into the portfolio in late 2019. I think in December 2019. So the reason why we include healthcare into the portfolio is that we think that aging population is really the main issue that every one of us globally are facing. And the aging population issue is a catalyst or is a driver to increase the demand for the healthcare services and also healthcare products. On top of it, we think that the demand for healthcare products and services is going to be very resilient regardless of the economic condition. For example, a diabetes patient, no matter of whether or not right now we are in a recession or we are not in a recession, this patient will still going to pay for the insulin. This is some of the product that's necessary for the patient. So the resilience demand is really something that's going to makes the earning growth for the healthcare sector to be sustainable in the future. On top of it, the valuation is very attractive for the global healthcare sector. Right now, it is trading around -1 standard deviations. It's way below the 5 to 10 years average level. So overall, we actually quite bullish for equity. For equity perspective, we're actually quite bullish on Asia, Japan, China, and also global healthcare sector. For technology, recently we have just included into the portfolio, but because the valuation is rather rich, so we keep a neutral allocations. The space that we're underweighting is the US and also European equity. For fixed income side, we have added a tactical position into US high yield. Then we underweight in Malaysia short duration because we think that the upside potential for short duration bond fund is rather limited. We have a neutral position for Malaysia long duration, Asian bond, and also emerging market bond. So this is the allocation for our portfolio. So the funds that we have selected for US high yield is the Affin Hwang US short duration high income funds. And the fund that we have selected for our technology exposure is Principal Global Technology Fund, Ringgit H cost. And for Islamic portfolio, this is the funds that we have included for the portfolio. Yeah, so recently we have just replaced RHB Islamic Bond Fund with Maybank Malaysia Sukuk Fund. Yeah, other than that, is rather it is similar to our previous allocations. And just a quick summary about what I have shared over the past 30 minutes, 35, or over the past 1 hours. Yeah. So overall, we think that macro data, the headline data or the earnings is likely to be very weak over the next 3 to 6 months. And this could be one of the factors to further induce volatility in the global equity markets. But we must know or we must acknowledge the fact that equity always ahead of global macro data. So much of this negative data has been priced into the equity prices. Valuation wise, we think that the valuation for the global equity market is very attractive, even if it cuts earning by 10 to 15%. If it accounts for the pessimistic scenario, the valuation for the global equity is still remain rather attractive. And right now, we are actually overweighting equity by 5%. We are underweighting fixed income by 5%. We think that from the valuation perspective, and if we were to position for the next 3 to 5 years, we think we see a higher upside potential in the global equity market as compared to the fixed income exposure. We are positive in Chinese equity. We are also positive in technology and also healthcare sector with the factors that I've mentioned earlier on. So before I call it a day, before we move on to the Q&A sessions, let's share the one last part, which is the million-dollar questions. I think this is also many of the investors they would like to ask. The question is, should I buy now? Is the bottom of the equity market is now the bottom of the equity markets? Or should I wait for the market to decline further? If you think from, if you look at the chart here, right now probably we are at this level, point at the level of now here. Sorry, yeah, probably we are at this level now. There is a possibility that the market could fall further from the current level to the point A level. But what we are certain is that eventually, if you are positioning yourself for 3 to 5 years, what we are very certain is that the market will eventually trend to the point B level. And this is something that we are very certain at. And just to share with you all, if you were to position yourself for 3 to 6 months, meaning that you were to position yourself to capture the upside of the equity market, to bet whether or not the market will move up and down over the next 3 to 6 months is extremely difficult, because what we have been telling our investor all this while is that don't try to time the market, because timing the market, position yourself for a short investment horizon is similar to you going into a casino and placing whether big or small. So it's a 50-50 chance to get it right, if you are positioning yourself for a short period of time. But if you are positioning yourself over the next 3 to 5 years, I think the possibility of you winning this will be 80-20 instead of a 50-50 kind of a bet. So what we also want to, another message I want to convey is that all this while, I think investors will have misunderstand something. To make profit in an equity market or to make profit in your investment, it's not exactly that you need to buy lowest and sell highest. You don't need to buy exactly at the lowest point and sell exactly at the highest point in order to make profit in the markets. But in fact, you need to increase the chances of you winning in the markets. First thing you need to do is to stay invested in the market, increase the investment horizon, then focus on some of the fundamentals and also valuation of this market. These are some of the key things that we should do in order to increase the chances of us winning when it comes to investment. And the other thing to share with all of you also, if some of you have capital to deploy, my suggestion is not to fully deploy all your capital at this point of time, because as I mentioned earlier on, we still expect the volatility for the global equity market to remain very, very high over the next couple of months. Reason because the headline data is likely to be very weak. Equity globally, the analyst is likely to further downgrade the corporate earnings. So these are some of the things that could induce further volatility in the global equity market. So it's better for us to position ourselves. Don't put all our money once lump sum into the markets. You can separate out. You can split out your capital into 3 to 4 tranches. Gradually invest, gradually deploy your capital into the market whenever the market drop 10 to 15%. or to gradually deploy your market every 2 months from this point of time. So these are some of the strategy that we were to suggest to our investor. But it's really don't because right now, if you look at the current situation, yes, we have been seeing a lot of stimulus being put in by the central bank, but we also think that the current rebound would be a bit too significant. If you look at it, market generally have rebounded more than 25 to 26%, especially the US equity markets. Fundamentally, these the global listed companies, or a lot of the companies right now, they fail to provide guidance for their futures earnings, and this is really something bad. And we see this could be one of the factors that could drive more volatility to global equity markets. So don't use up all your capital at once. Spend it properly. Split our capital into a few tranches and deploy it gradually into the equity markets. Yeah, so I think with that, I come to the end of my sharing sessions. So we'll be happy to take any questions from the crowd. Yeah, so let me check on the chat box.
So thank you, Jerry, for the sharing sessions. So if you have any questions, you can actually type it and then forward it to Jerry. Okay, his name in this chat room is FSMOne _ Jerry. So along the talk, there were some investors who actually sent the question to me. I have also forwarded it to you already, Jerry.
Okay, let me open up the chat box because I think we have the first questions. What is driving the market rise from end of March onwards, even though economic outlook is very bad? And how long this push will last? Question: when will the market hit the bottom? Just the month will do. I wish I really know when will the market hit the bottom. It's very hard to predict, as I mentioned just now. But just to address the first questions, what has been driving the markets to rebound from the low towards the end March? So the reason why is because I mentioned just now the stimulus that have been put in by the global central bank and also the government. So it's more from the central bank perspective. I mentioned just now. I think we have been hearing the quotes, people saying "Don't fight the Fed." It basically means that when Fed is injecting liquidity in the markets, I mentioned just now, money has to find a home. Like it or not, when there's excess liquidity in the markets, if you look at US Treasury, the yield is very, very low. If you are putting your money into FD, even in US, you're not earning any interest. So money have to find somewhere to park. And because of this excess liquidity, a lot of the money have been floating into the equity markets. And this is one of the key reasons that has been driving the rebound in the global equity markets. And what we have been seeing right now is that the headline data is going to be very, very bad. But to a certain extent, I think a lot of the fund, if we have been because we have been talking to a lot of fund managers, we also understand that a lot of the fund managers they are trying to look beyond the current year for the corporate earnings. Meaning that they know for sure for the year of 2020, the corporate earnings will be very, very bad for most of the sector, for most of the companies. So they are trying to look beyond the current level and see and look into those companies that the prices have dropped significantly, but the outlooks of their earnings beyond this year is still look very healthy and very encouraging. So they are going to invest into this kind of company. And I think institutional money is also another factor that have been driving the rebound in the equity market, especially for Malaysia small cap. If you look at it, a lot of the insti players that have been buying into the small to mid cap sector, especially some of the technology names. If you look at Malaysia tech counters, I think most of the big names, right, they have rebounded more than 60 to 70% from the bottom level. So these are some of the things. But exactly to answer the last question, when market will hit the bottom, I have no answer for this. But the questions, my suggestion to you is that we don't need to know when exactly it will be the bottom for the global equity markets or for the fixed income markets. What we need to do is that we need to understand from the current point of time, is it the market looking attractive? Is it that if we are positioned ourselves for 3 to 5 years, are we going to have a high chance of making money? If that is the case, we should start to invest now. and gradually deploy our money. And my suggestion to you is not to put all your money once lump sum into the market right now. Try to split out your money into a few tranches and to deploy gradually. That's because there's a fact that we need to acknowledge that we wouldn't be able to time the markets. Without a crystal ball, you won't be able to know over the next few weeks where the markets are heading. Yeah. What do you mean by underweight, neutral, and overweight? Okay, so for our asset allocations, we have a specific neutral allocations for certain markets. For example, our neutral allocations for US equity is about 20%. The Europe equity is about 20%. So when we say we underweight, means that we are going to deploy less than 20% into US equity. When we say neutral, it means that if our neutral allocation is 20, we are going to put 20% into US equity. Overweight means we are putting more than the neutral allocation. Take a very good example. If we look at assets, the fixed income versus equity, for a balanced portfolio, the neutral allocation will be 50-50. 50% equity, 50% fixed income. So if we are underweighting equity, means that we have less than 50% in equity. We have more than 50% for fixed income. But if we are overweighting equity, means that we have more than 50% in equity and less than 50% for fixed income. So this is what it means by underweight, neutral, and also overweight. So we have a neutral allocation for all our allocation, be it the inter-asset allocation, which is equity versus fixed income, or the intra-asset allocation, each of the geographical segment. I think we didn't put up the we have a questions of iFast versus FSMOne portfolio. I think for iFast is another segment of another business segment for us. It's on the B2B side, business to business side. I think that one, if you have an advisor, you can actually consult your advisor to know about the difference. But right now we are actually more focusing on the FSMOne side. Yeah. From FSM perspective, do you see inflow or outflow of funds instead of? Yeah, this is very interesting questions, and I think this also, if you don't mind, I also would like to share some experience based on our previous experience, especially after 2017, after a very good year. That 2018 become a very bad year for the global equities. So all this while, if you look at our investor sentiment, it has been driving by the market performance. When market is good, investor tend to buy. When market is bad, investor tend to sell. So all this while, we know that buy low, sell high is a strategy, but end up we actually, based on our observation, we realize that most of our investors, if instead of buy low, sell high, they actually buy high and sell low. Yeah. So in terms of fund flow, I think in March we actually see quite a significant outflow. Yeah, because generally market situation is really, really bad. A lot of investors are really afraid of the volatility on the equity market side. But what we really encourage investors to do is stay invested in the markets, because I mentioned just now, no one would have expected that the rebound could be so strong in April. Market rebounded more than 20%. So imagine if you are trying to time the market and you exited the markets in March, you would have missed out the more than 20% kind of a rebound in the global equity market. So yeah, we really hope every one of you don't try to time the markets, because it's really something that's very, very difficult. And most of the time, based on our experience, for some of the investors who try to time the markets, they would end up miss out the strong rebound in the global equity markets. Yeah. What is the view on India markets? I think it's pretty attractive at this moment. Okay, if you invest into India, is a little bit tricky. It depends how you position yourself. If you are positioning yourself for more than 5 years, I think it's very attractive to invest into India right now. Valuation-wise, they are not exactly very attractive. Valuation is a bit expensive. Then if you look at from the fundamental perspective, I think a few things we need to look at. First thing first, we look at in terms of COVID-19 front, right? I think right now, I think the outbreak just started in India, and if they do not learn from the previous experience, which is during the Spanish flu period, if things really worsen to an extent similar to Spanish flu back in 1919 that time, I think it will be quite bad for India economy. But hopefully, hopefully that they can manage it well. Otherwise, I think there will be a very significant impact to India economy. Second thing is on their banking sector. I think with the recent COVID-19 outbreak, I think the banking sector will see very difficult periods in months or quarters ahead. If you look at some based on some of the research that we are looking at, the bad debts, the bad debts for banking sector as a whole in India is expected to be double by the end of this year. So these are some of the challenges that they are facing. And in terms of, but the good thing is that with the recent COVID-19 outbreak, right, we think that it's actually given Modi upper hands to fast track some of the policy that he had been putting up. He wanted to implement. So long-term structural outlook for India, we think that is quite positive. But over the short to mid-term perspective, we think that the volatility should remain quite high for India equity, especially that the valuation for India equity is not exactly cheap at this moment. How much allocation you have repositioned in US high yield, and whether your benchmark is global aggregate bond index IG would be reflective of your rebalancing towards high yield? Yes, I think, okay. I think this is a very good question. I think this gentleman asked, how much of your allocation you have in US high yield? And after we rebalance our portfolio to include US high yield into the portfolio, is our benchmark, which is the global bond aggregate index, which is IG, investment grade benchmark, will be reflective of our current portfolio structure. So just to share with you all, why, when we have a benchmark, it actually means that will be our strategic, it was actually based on our strategic asset allocation. I mentioned just now, the US high yield is part of our tactical allocation. It means that these are some of the active investment changes that we have made to the portfolio. So when we do this kind of active decision or the active allocation, we wouldn't change our benchmark, because if we were to do so, right, every time when we add some different segment into the portfolio, we will have different benchmark for the portfolio. So this is considered, if we are making good returns from the US high yield side and make higher return compared to the global aggregates benchmark, it means that we deliver higher alpha for our portfolio. So these are the active decisions that we have taken for the portfolio. So whenever we do this kind of tactical changes, it would affect our benchmark. Yeah. If one have limited funds, what is your advice, and how do you see risk funds? Okay, if you have limited funds, I would still encourage investors to have, even if you have a limited funds, I think right now the minimum investment for UT fund is rather low. It is still, if you have you are still able to construct a portfolio for yourself. Or even if you want to invest into the managed portfolio, we help you to diversify across different asset class and also different geographical allocations. The minimum investment for our DPMS, our managed portfolio, is just about 1,000. So it will help you to have a perfect diversification. So if you really have limited funds, why not try out the managed portfolio, which will help you to really diversify your asset, with a limited capital. How do you see REIT funds? For REIT sector, I think right now, if you look at REIT sector as a whole, the yield, because the earnings have been slashed significantly, the sector as a whole, they will be impacted by the COVID-19 outbreak, especially if you look at commercial REITs. I think the short to mid-term impact to the earnings is quite significant. So I think earnings have been slashed significantly. Right now the dividend yield for REIT sector is trading about close to 4+ to 5%. It's not exactly very, very attractive. But if you were to position risk into your portfolio as a more defensive sector, I think that's still doable. But if you look at in terms of upside potential, we still think that segment like China equity, segment like technology, and also healthcare sector, these are some of the segments that offer investors with a higher upside potential. Thank you for the talk. All of the above are invested in unit trust fund from local fund houses, not individual stock. As such, is the portfolio able to capture the sudden movement swing in the global stock, which are so volatile at the moment? Yeah, so I think this gentleman asked a very good question. It means that because right now we are investing into unit trust fund. So if you were to compare into your investment into individual stock, I think that one will be more nimble, in terms of the timing wise, the gap between you buy and sell, it will be shorter. So for unit trust, usually what our advice our investor is to position yourself for a long period of time. Don't position for 3 to 6 months, meaning that today you want to buy, today because US equity have dropped 10%, or you want to buy into it, then the next few days you want to sell. So in this kind of volatile market environment, you might not be able to capture exactly the fluctuation or the price movement of the global equity markets. But if you were to position yourself for at least 3 to 5 years, I mean, when it comes to unit trust investment, I think most of investors, they are positioned for a longer period, longer investment horizon. So if you are positioning yourself for a longer investment horizon, I think there wouldn't be an issue to really capture the movement in the global equity markets, even if you're using unit trust funds. While you are recommending technology funds, the fund is concentrated on US counter. Is there a tech fund in the market that concentrate on Asia market? I think this one we need to, first of all, would like to clarify one thing. Although a lot of the technology fund, they are listed in US, but if we are going to analyze on their revenue and earnings, right, majority of these technology counters, their earnings and their revenue, they are not deriving from the US market itself. Because if you look at the current tech space, the tech sector, they are listed in US, they could be earning their revenue and earnings in the rest of the world. So in terms of geographical exposure for their revenue and also for their earnings is quite diversified. It's not really concentrated in US. It's just that most of the technology funds, they are listed in US. But in terms of their markets itself, it's not really concentrated in US as first thing. Second thing, is there any tech funds in the market that's concentrated in Asia? I think right now we really don't have any technology funds that is focused on the Asian market. But if you are interested in ETF, right, in our Singapore platform, we have a Chinese technology ETF. Yeah, so that one maybe is something that you are interested. I think we still have a lot of questions. I will just pick a few to answer. I pick another 3 to answer. The rest of it, very sorry we couldn't take all your, we couldn't take all your questions. But if you all have any questions, you can actually send in to our client investment specialist, our CIS, and we will reply to you. I noticed that managed portfolio does not provide any dividend. Am I correct? Yes. Most of the income distribution will be reinvested for our managed portfolio. Do you think that a further political instability in Malaysia will affect your assessment that you have shared just now? Yeah. So I mentioned just now. Right now for Malaysia equity exposure, we have a favorable view in Malaysia small cap. So we try to avoid those big caps company or those political links company. We have been talking to the fund manager. I think this is also some of the view that they have. So we also just to share with all of you, for the funds that we have invested, we will keep in touch with the fund manager on a regular basis. Every quarters or every 2 to 3 months, we'll actually talk to the fund managers to interview them, see whether or not there's some alignment between our view and their view. So we have talked to some of these fund managers that invested into Malaysia small cap space. We also understand that most of the fund managers, they are avoiding some of the political links company. So if you look at equity as a whole, equity market as a whole, it will be affected by the political uncertainty. But the fundamental itself of this company, it won't be affected by the political uncertainty. So maybe in terms of equity prices or on the short to mid-term perspective, when there's a change in government, when there's a massive sell-off in the broad market, in the big cap segment, it will actually affect the small to mid cap segment. But when it comes to recovery, these companies that still fundamentally very strong, they will see a much stronger recovery. So these are some of the things that the fund manager are positioned themselves in. So they are positioned themselves in some of the sectors that have very strong and resilient demand or very positive outlook, and the earnings is very resilient. Yeah. So in terms of the political uncertainty, instability is something hard to predict. But then we are trying our best to avoid some of the political link company to minimize the impact to the overall portfolio. Can you display again the aggressive allocation in the portfolio? So maybe I need to move on to my slide. All right, okay, so this is a slide for the portfolio allocations. Is it too late to enter into Chinese equity? Right now, if you look at from various perspectives, on a year-to-date, okay, first of all, look at on performance perspective. So there's this question: is it too late to enter into Chinese equity market? So if you look at from various perspectives, first of all, we look at from performance perspective, year-to-date, Chinese equity is still down about 2 to 3%. First of all, if you look, that one is from performance perspective, is it have not rallied too much, from the bottom level. In fact, if you look at the drawdown in Chinese equity market, they have been rather resilient. Then second thing, if you look at from valuation perspective, the market is still currently trading at a very attractive level. So if you were to invest into Chinese equity, it depends which segment that you want to invest into. Because to invest into Chinese equity, there are a lot of funds on our platform. If you want to concentrate your exposure into the consumer related sector, this is discretionary and this consumer staple industry, I think the FSMOne Chinese A opportunity could be one of the fund that you want to consider. But if you want to gain some of the tech exposure, more of the financial exposure, then you might want to consider the Principal Greater China Equity Fund. So my answer to you is that it's not exactly very late to enter into Chinese equity right now. In fact, we have a very, very bullish view on Chinese equity. We think that moving into the next few quarters, especially from the second half onwards, we are likely to see a very strong rebound in Chinese economy. The Chinese economy is likely to lead the global economy from this round of a recovery. So we think that over the next 1 to 2 years, Chinese equity is likely to outperform the rest of the equity globally. How will the global and China equity funds be impacted if Trump continues to fight with China? I think this is regarding the recent escalated tension between US and China, where Trump mentioned that he's going to impose higher tariff to penalize China on the COVID-19 outbreak. I think this guy is really difficult to predict what he's going to do. We also have a lot of investors asking us whether or not is it possible that Trump will really impose further tariff on Chinese imports. I think it's very difficult to predict, but but we need to analyze the situation, the scenario. At this point of time, it's getting nearer to the year-end election for Trump. And if he is really going to do so, that's going to affect the equity market as a whole very, very badly, especially with the current fragile environment. If he's going to impose a tariff, I think the chances is NASDAQ or S&P 500 is going to drop another 15 to 20%. So from that point of view, we would think that the possibility is there, but it's quite low for Trump to go against China. And if it does happen, let's assume for the worst case scenario, if Trump really go against China, I think which are the segment that could spare from this kind of a sell off. I think Chinese equity, if you focus on China A share, this will be the segment that is likely to be rather resilient, even with escalated tension between US and China. Because think about it, China A share, if you look at China A share as a whole, 90% of their revenue and profit come from the local markets. Yeah, so they are not the export relying sector. So position yourself into China A, it will be something that help you to skip away from this kind of escalated tension between US and China. Yeah, so the rest of the world, I think they will be impacted. And if really the tension is is going to further escalate from the current level, I think market will be quite bad over the next couple of months. Yeah, I think with that, I came to the end for today's sessions. Really thanks every one of you for joining us for today's sessions. If you still have any questions to ask, really apologize that we couldn't answer all the questions. If you have any questions to ask, please send in your email to our CIS. We will try to reply you as soon as possible. Yeah, thank you everyone.
Okay, thank you everyone for joining the webinar. So we will end the meeting in a short while.